Think utilities are safe? Think again. Warren Buffett just revealed a shocking truth. The Oracle of Omaha just shattered a decades-old investing myth. This isn't just another market prediction, it's a wake-up call. Because the safest investment in your portfolio might be the next to crash. Warren Buffett warns of market crash possibilities while also sitting on a massive $347 billion cash pile at Berkshire Hathaway. His rather cautious stance comes at a time when market volatility and regulatory uncertainty are definitely increasing, suggesting that he might be preparing for some potentially significant market downturns in the future, even though he still maintains a generally optimistic long-term outlook. Every investor needs to hear, especially those who believe in playing it safe. A corner of the stock market that's long been considered a safe haven may no longer be so safe. And it's all because of one growing threat: wildfires. Over the weekend at Berkshire Hathaway's annual shareholder meeting, Warren Buffett, arguably the greatest investor of our time, delivered a stark warning. Not about tech stocks, not about the economy, but about utilities. Yes, utilities, the bedrock of conservative investing. The sector where retirees park their money for stability. The one that's supposed to be boring, dependable, and safe. But according to Buffett, that's no longer the case. The public utility business is not as good a business as it was a couple of years ago, he said. And the reason? For decades, electric utilities were considered one of the most defensive sectors in the market. These companies provide essential services. People use electricity in good times and bad, so revenues stay steady even during economic downturns. But things have changed. Climate risks, especially wildfires, have turned this once safe industry into a minefield. Let's break down exactly what Buffett's warning is about and what it means for your portfolio. Recent history is filled with sobering examples. In August 2023, shares of Hawaiian Electric crashed by as much as 76% after the company was linked to the devastating Maui wildfires. Those shares still haven't recovered. Then there's PG&E, Pacific Gas and Electric, the utility giant in California. Between 2017 and 2021, the company's equipment was found responsible for sparking multiple wildfires. The damage was so severe, PG&E had to file for bankruptcy. Its stock lost 95% of its value. And in early 2025, Edison International, another major California utility, saw its shares plummet 37% amid fears it would be held liable for the Palisades fire in Los Angeles. This is a disturbing trend, and Buffett is paying close attention. Now, here's the real kicker. Even Berkshire Hathaway isn't immune. Buffett admitted that Berkshire Hathaway Energy, his own utility subsidiary, has lost significant value. He attributed this to what he called societal factors, a veiled reference to the increasing legal and financial liability utilities face from climate-related disasters. Berkshire Hathaway Energy is worth considerably less money than it was 2 years ago, Buffett admitted. And this isn't just about future risks. It's already costing real money. Take PacifiCorp, a utility owned by Berkshire. After the 2020 Labor Day fires in Oregon, the company has paid over $1 billion in settlements, and more lawsuits are still pending, with potential damages in the tens of billions. As Greg Abel, Buffett's handpicked successor, bluntly put it, "We can't just become the insurer of last resort that's going to cover any cost and all costs irrespective of what occurred." This warning about utilities is just one part of a larger picture Buffett is painting for investors. Despite being one of the most active and successful investors in history, Buffett has spent the past few years holding back. He's been accumulating cash, a lot of it. As of March 31st, Berkshire Hathaway is sitting on a record $348 billion in cash and U.S. Treasury bills. Think about that. At a time when markets are in turmoil and prices are correcting, Buffett isn't diving in. He's selling stocks. In fact, Berkshire has been a net seller of stocks for 10 straight quarters. That's not just a stat, that's a signal. History shows that the market tends to follow Berkshire's lead. When Buffett is a net buyer, the S&P 500 tends to perform better over the following year. On average, the S&P 500 returns 20% in the 12 months after such quarters. But when Berkshire is a net seller, as it is now, the S&P 500's average 12-month return drops to just 12%. And that's not a coincidence. Buffett's caution often foreshadows broader market weakness, or at least turbulence. Even as he sends warning flares about utilities and sells off individual stocks, Buffett's message to the average investor remains the same. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. Warren Buffett, 2013. Letter to shareholders. It's advice he's repeated for years, and it's not just lip service. In 2007, Buffett bet $1 million that an S&P 500 index fund would outperform a portfolio of hedge funds over a decade. And guess what? He won. By a landslide. So, while Buffett may be steering clear of individual utilities and sitting on a mountain of cash, he continues to champion simple, long-term investing in broad-based index funds. This year's shareholder meeting also came with a bombshell announcement. Buffett plans to step down as CEO of Berkshire Hathaway later this year. The legendary investor and Berkshire Hathaway boss made the surprise announcement in the closing minutes of a nearly 5-hour-long Q&A on Saturday at his company's annual meeting in Omaha. The packed stadium was stunned into silence. The longest-serving S&P 500 CEO, who took the top job in 1970 and built Berkshire from a failing textile company into a $1 trillion company known around the world, was stepping down. It seemed as if Buffett, who is 94, might continue for a few more years still, given how mentally sharp he seemed throughout the morning as he fielded questions about everything from tariffs and Berkshire's huge cash pile to government spending and life advice. Buffett's thousands of shareholders rose again and clapped as he prepared to leave the stage, leading him to joke that their praise could be interpreted either as admiration or relief that he was resigning. The atmosphere turned to sadness and disbelief as onlookers processed what had just happened, and its historical significance began to take hold. The 94-year-old investing legend will pass the reins to Greg Abel, who has overseen the company's non-insurance operations, including its utility businesses. Buffett's influence, however, will remain monumental. His legacy is built not just on stock picks, but on philosophy, on discipline, patience, and the long view. "It's not unlikely to happen in 5 years," Buffett said about a buying opportunity, "but it's very unlikely to happen tomorrow. In other words, be patient, sit on your hands if you must, wait for the fat pitch." So, what does all this mean for you? Here are 5 takeaways from Buffett's powerful message. Don't blindly trust safe sectors. Even long-standing defensive sectors like utilities are vulnerable to new risks, especially environmental ones. Watch what Buffett does, not just what he says. His recent moves suggest caution, not aggression. Cash is a position. Buffett's massive cash hoard is a signal. You don't always have to be fully invested. Expect volatility. When Buffett is a net seller, the market often struggles. Plan accordingly. Stick to the basics. For most investors, a low-cost S&P 500 index fund is still the smartest play. Warren Buffett has spoken. The message is clear. Even the safest havens aren't immune. In a world of rising risks, from climate to geopolitical tensions to inflated valuations, prudence is power. The best investors don't just chase returns, they manage risk. And right now, Warren Buffett is managing risk like never before. Despite all these cautionary warnings about investment risk, Warren Buffett warns of market crash possibilities while also maintaining his characteristic long-term optimism. "The long-term trend is up," he reassured shareholders, while acknowledging the unpredictable nature of short-term market movements that we're seeing. Buffett's enormous cash reserves signal both genuine concern about current market volatility conditions and also serve as a timely reminder that patience and discipline remain absolutely fundamental to investment success during periods of increased market volatility and ongoing regulatory uncertainty. So, what do you think? Are you staying in utilities, sitting on cash, or following Buffett's timeless advice to buy and hold the S&P 500? Drop a comment below. We'd love to hear your take. Don't forget to like, subscribe, and hit the bell icon so you never miss insights that can move your money. Thanks for watching, and until next time, invest wisely.